Hello, I'm Sebastian. Welcome to 9 Trees podcast. Today, I will summarize and review the book. The Tao of Trading, How to Build Abundant Wealth in Any Market Condition by Simon Rhee blends practical market guidance with a mindset framework inspired by Taoist ideas of balance, flow, and disciplined non-attachment. Positioned for traders and investors who want steadier performance across bull, bear, and sideways markets, the book emphasizes process over prediction. Reframes trading as a craft where outcomes improve when readers focus on risk control, emotional regulation, and repeatable decision rules rather than chasing hot tips or forcing trades. The core promise is not a secret indicator, but a way to operate with clarity when uncertainty is highest. Across its themes, the book highlights preparation, planning, and the ability to adapt as conditions change, aiming to help readers avoid common pitfalls like overconfidence, revenge trading, and excessive leverage. Its approach resonates with readers who appreciate both psychological insight and actionable structure, seeking a calmer, more durable path toward long-term wealth building. I will give you key takeaways from this book. Firstly, a Tao Inspired Trading Mindset, Clarity, Detachment, and Flow. A central topic is how a Tao Inspired perspective can improve decision-making in markets that are inherently uncertain. Rather than demanding certainty, the approach encourages acceptance of randomness and a focus on what the trader can control: preparation, execution, and risk. Detachment in this context does not mean indifference. It means reducing emotional attachment to being right, to a single position, or to a specific market narrative. By loosening that attachment, traders can respond faster to new information and avoid turning a small loss into a large one. The idea of flow is presented as alignment between a plan and real-time conditions, where the trader acts when signals and risk parameters match, and refrains when they do not. This mindset also supports patience, a trait often missing in active trading. Instead of forcing action, the reader is nudged to respect periods when markets are noisy and probabilities are unclear. The broader benefit is a calmer operating state that can reduce impulsive entries, help maintain consistency, and protect confidence through inevitable drawdowns. Secondly, risk management as the foundation of abundant wealth. The book places risk management at the center of wealth building, treating it as the primary edge that keeps a trader in the game long enough for skill and opportunity to compound. This topic focuses on defining risk before entering a trade, controlling position size, and setting exit rules that prevent catastrophic losses. Instead of relying on a high win rate, the emphasis is on favorable risk to reward and the discipline to cut losses quickly when a thesis is invalidated. Readers are encouraged to think in terms of probability distributions and drawdown limits, aiming to avoid emotional decisions once money is at stake. Risk management is also framed as psychological protection because smaller controlled losses are easier to accept and learn from, reducing the likelihood of revenge trading. Another key element is diversification across setups or market regimes, preventing overexposure to a single idea. By treating trading like a business with inventory and operating costs, the reader learns to budget risk, measure performance, and preserve capital through adverse conditions, which is essential for long-term compounding. Thirdly, adapting to any market condition, bull, bear, and sideways. To support the promise of performing in any market condition, the book emphasizes adaptability and regime awareness. This topic concerns recognizing whether the market is trending, mean reverting, highly volatile, or muted, and adjusting tactics accordingly. In strong uptrends, the approach favors participation with defined risk while allowing winners to run. In downtrends, it highlights caution, defensive positioning, and the importance of not fighting momentum. In sideways markets, it focuses on selectivity, tighter risk controls, and strategies that do not depend on persistent trends. The broader lesson is to avoid using a single tool as a universal solution. Instead, the reader is guided toward building a flexible playbook where specific setups are matched to specific conditions. Adaptability also includes recognizing when not to trade, because staying out can be a profitable decision if conditions are low quality. By building awareness of volatility shifts and liquidity changes, traders can reduce whipsaws and avoid overtrading. The result is a more resilient process that can continue working as the market environment changes. Fourthly, building a repeatable trading process and personal playbook. Another important theme is the shift from sporadic trading to a repeatable process that can be tested, refined, and scaled. The book encourages readers to define clear entry criteria, exit rules, and invalidation points so decisions are less reactive and more systematic. A personal playbook typically includes a small set of setups the trader understands deeply, along with checklists that reduce errors under pressure. Journaling and post-trade reviews are positioned as essential feedback loops, helping identify which behaviors lead to strong outcomes and which lead to avoidable losses. Over time, this process orientation helps separate luck from skill by tracking metrics such as expectancy, average win to average loss, and adherence to rules. The playbook concept also supports consistency because it limits the temptation to chase new strategies after a short losing streak. By treating improvement as incremental, the trader can evolve without constantly reinventing their approach. This topic ultimately reinforces the idea that abundance comes from consistent execution and continual refinement, not from one big trade. Lastly, emotional discipline and the psychology of performance. Trading performance often collapses not because of poor market knowledge, but because of unmanaged emotion, and the book highlights psychological discipline as a practical skill. This topic covers common mental traps, such as fear of missing out, loss aversion, overconfidence after wins, and paralysis after losses. The Tao influence supports a calmer internal stance, where the trader observes emotional impulses without immediately acting on them. This can translate into waiting for confirmation, honoring stop losses, and avoiding the urge to increase size to recover quickly. The book also frames discipline as an energy management problem. Sleep, routines, and preparation affect decision quality as much as analysis does. Readers are encouraged to build habits that reduce stress and improve focus, including pre-market planning and clear rules for stepping away when emotions spike. Another key point is identity, shifting from needing to be right to needing to follow a process. Over time, this psychological training can stabilize results, improve learning, and protect the trader from burnout, supporting longevity in the markets. In conclusion, this book best suits active traders, swing traders, and serious investors who want a framework for navigating uncertainty without relying on constant prediction. It can also benefit beginners who feel overwhelmed by indicators and opinions because it emphasizes building a disciplined process, managing risk, and developing the mindset needed to stay consistent. The life benefit is broader than trading. Readers practice patience, emotional regulation, and decision-making under pressure, skills that carry into business and personal finances. By anchoring actions to rules and probabilities, the reader can reduce impulsive behavior, avoid large avoidable losses, and improve the odds of long-term compounding. Compared with many trading books that focus narrowly on a single strategy or technical tool, this one stands out by pairing practical trading structure with an enduring philosophy of balance and adaptability. That combination can help readers create a resilient approach that remains useful as markets change. For buyers looking for a calmer, more sustainable way to pursue market profits, the book offers a clear direction: build a repeatable playbook, protect capital first, and let disciplined execution do the heavy lifting over time. If you would like to support Simon Rhee, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.